In my mind, I'm gone to Carolina. Can't you see?
Greetings and welcome back to Fisher Wealth Management's Tips of the Week. I'm Rick Fisher, Managing Partner here at Fisher Wealth Management, and this week's tip is about your bond portfolio. A well-diversified portfolio historically has consisted of some of your investment assets being in the stock market, some of your investment assets being in the bond market, and some of your investment assets being in cash. Well, today's tip is going to be about the bond market. We've been able now for about the last 80 years or so to track investor behavior through inflows and outflows of packaged products. And one thing we've noticed is since the financial crisis of 2008, we've had an unprecedented amount of cash flowing into bond mutual funds. And so I know that many of you as investors own bonds. Well, it's important that you understand what types of bonds you own and how they will behave. So this week's tip is about understanding bonds. Bonds don't grow, bonds pay interest. We've used bonds historically to give us a hedge from the stock market. They don't typically move up and down in concert with what's going on in the stock market. So it diversifies your portfolio. Maybe as the stock market's going up and down, the bond market's doing so less. But bond market definitely does fluctuate. And it fluctuates really based on two things. Number one is the perceived credit risk of the issuer. And the second thing that causes bond values to fluctuate one way or another is the prevailing movement in interest rates. Now, I know that's a mouthful, but let's take both those briefly. The first thing that affects the bond market is the perceived credit risk of the issuer. So if you will consider XYZ Corporation, and I am going to invest in the bonds of XYZ Corporation, if that company is deteriorating, meaning their balance sheets get messed up, business is not good, it's declining, most likely the value of their bonds will decline. Why is that? Well, that's because their ability to repay me, or their perceived ability to repay me, has declined. So the market value of that bond in that scenario would typically decline. By comparison purposes, if XYZ Corporation's balance sheet is improving, their business is improving, their ability to repay me is also improving, that will typically be helpful to the market value of my investment in their bonds. The second thing that moves bonds is interest rates. And I want you to think of it kind of like a seesaw. You know, if interest rates are going up, bond values are going down. If interest rates are falling, typically bond values of bonds you currently hold will rise. And if you think about it, if I'm investing in a bond of a company that's paying me a 5% income, but interest rates rise and a comparative bond now would pay me a 6% income. Well, who in the world wants my 5%er if they can go out in the open marketplace and find one that's going to pay them 6%? So because of that, the current market value of what I own will be less, because they're not going to pay me full price when they go in the open marketplace and get something paying them a higher rate of interest. So if you want to think of, if you think we're in an environment, as we do, that is likely to be a rising interest rate environment, meaning rates are more likely over the next handful of years to rise than they are to fall, then be very careful of what types of bonds you own. The longest term, highest quality bonds fluctuate the most based on interest rates. So meaning the 30-year U.S. Treasury bond, if interest rates rise because it's considered to be a risk-free investment, it will fall the most in value. By comparison purposes, if interest rates fall, typically it will rise the most in value. Remember, there's that inverse relationship. So, why am I explaining this to you in my tip of the week this week is because I know many of you own a good slug of bonds in your portfolio. It has historically been a very critical part of a diversified investment portfolio. But in this environment, that is most likely to be the first rising interest rate environment that you've seen in decades, it is very important that you understand what you own and how this type of environment will affect it. So, if you're not having these types of conversations with your advisor of choice, we do welcome you to call us down here at Fisher Wealth Management, where we have a world of education, independence, and experience in helping people understand what they own and making certain that what you own is the most appropriate thing for you and your family at this time. So thanks again for listening, and stay tuned for more Fisher Wealth Management Tips of the Week.
Feel the moonshine, ain't it just like a friend of mine to hit me from behind?